Welcome back to the Open on BNN Bloomberg. Thank you so much for being here. Markets are higher, as we just saw in early trading. There they are again, as investors wait for the Federal Reserve Board. That's the big event of the day. That interest rate decision is due at 2 p.m. Eastern Time. It, of course, will be scrutinized for the policy outlook rather than the action, which is expected to be no rate increase. We're joined now by Laura Lau. She's Chief Investment Officer of Brompton Group for her take on the Fed and markets more broadly. Laura, thanks for joining us.
Great to be here, Paul.
What are you expecting from the Fed? I assume you're expecting no hike. What would you be looking for in the dot plots or some of the updated economic forecasts?
So, we are seeing that the market is forecasting perhaps there could be, another interest rate increase this year, more likely next year. But I think the story will be higher for longer, and we are data dependent, which they've said all this time. And we've seen already in Canada that inflation's starting to tick up again, and that's really driven by oil prices.
So you believe the Fed will not raise again in this cycle, but it will be a longer wait than markets have anticipated for rates to actually come down?
That's a great summary.
When do you expect rates to come down?
Well, right now the market's not anticipating till August next year. So, and we've seen economists, strategists all over the street pushing out, the probability of recession and pushing the date out.
How likely is the much hoped for soft landing, bringing inflation down without triggering a recession?
So what we are seeing is certainly the labor data is improving. As I said, what could throw a spanner in the works is oil, because oil prices are starting to tick up again.
Mm-hmm. How much of a spanner in the works?
Well, it depends how much oil rises. And so far, we have seen that Saudi Arabia has done a good job of supporting the price of oil. And the Strategic Petroleum Reserve in the U.S., they can't really, release much more. They're, in fact, buying back.
What type of portfolio composition do you think clients should have or investors should have given the outlook, the likelihood of a soft landing, but the higher oil prices? Do you, for instance, advocate owning energy shares?
So definitely energy shares are a good hedge against inflation, and it's also typically a good late cycle performer, and that's probably where we are now. So I do think energy shares is a good place to be. Another thing that does tend to do well would be industrials, especially since we're seeing so much spending on clean energy initiatives. They're the ones that tend to do better first. Your engineering firms, things that you need for, to build electrical grids.
Well, just on last question on oil, do you have a call on where West Texas Intermediate crude is going? It's at about 90 right now. So
I think we could go to 100, 105.
Okay. And on infrastructure spending and industrial spending, I guess, how influential and important for investors to understand is the Inflation Reduction Act in the United States, which, despite its name, has all kinds of spending devoted to green energy and green projects?
So I would say the Inflation Reduction Act is a great bit of marketing, but government spending is actually inflationary. So I do think it's going to be very long-term spending. Like, we're only starting to see projects being planned, projects being permitted. So it's probably going to give us like a decade-long runway of growth.
How do you believe Canadian stocks line up against U.S. stocks?
So I would say that, of course, Canada, we have less tech. And this has been the year of technology. We do have some great industrial stocks, and we do have some world-class energy stocks. Mm-hmm. So I do think that this year, the Canadian energy stocks can outperform the U.S. energy stocks. And part of the reason why is we're getting pipelines built. And with those pipelines being built, we're going to start getting higher prices for our oil, especially heavy oil, and we're actually going to be able to increase production.
Do you believe energy stocks can continue to move higher if the price of oil has only got about $10 more in it, which is in line with, I think, even the most bullish forecasts? The forecasts have been, a lot of the forecasters have been correct. They said in the second half of this year, the supply-demand fundamentals would drive crude to 90 to 100. We were at 93 yesterday. We've fallen back to about 91 now. So even according to the most bullish forecast, there's about $10 more to go in a rally that began at the $70 level.
So I do think that there can be some room to run, and part of the reason why is energy stocks are dirt cheap by any measure you use, any valuation metric. The other thing is they're actually behaving like businesses now, where they are worried about your return on equity, return on capital. They're giving back, increasing dividends. They're also increasing share buybacks. They're better businesses, period.
Laura, thanks.